The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Lovely to have you with us today. And good morning to our friends in Australia. And good afternoon if you're across the ditch in New Zealand. Would somebody please type in the question box? Let me know you can hear me all right. How's the volume? Norbert, is you always first up in the snowy parts of Canada. Thank you, my friend. That's great. That's good. Andrew as well. Thank you. Oh, Elon Musk. Well, what an important person to have with us. Thank you, Dave. He's a tutorial guy. So is Dean. Sounds fine. Oh, Norbert saying no snow up here. Mosquitoes. Hot here and mosquitoes. Goodness me. All right. Well, lovely to have you all with us, guys. And just got a whole lot to talk about today. Let's make sure all this is working. It seems to be. That's great. Let's have a look at all our guests today. Thank you for being with me today, folks. We've got Albert, tutorial guy, says Andrew and Bill. Cameron, he's a tutorial guy down in Melbourne. You're going back to work soon, Cameron, I guess. Chase, my nemesis who got me to give up smoking. And Christopher's with us. Chun's got up early, and Chun's up in Kuala Lumpur. In Malaysia, so he's got up pretty early to be with us. Dave, he's a tutorial guy, as I said. So's Dean. Graham, over there in New Zealand, lovely to have you with us, Graham. Thank you. Greg, Greg in Colorado. Good Lord, Greg. I always think of Colorado, the parts of it I'm most familiar with. Colorado Springs, where you are, as such a lovely place, but boy, they're going nuts in Denver, eh? Anyway, I guess we're going to talk about that as well. Jay's with us. Jay Anth is with us. Thank you. He's a new guy. Good to have you with us. Jeff, Jeff's going to do. Jeff S is going to do a tutorial sometime soon. Keith, he's another tutorial guy. So's Mark. L and Murph, of course, our regular. Good to have you with us. Noel, Norbert, we've greeted already. Peter, Mac, he's the short-term trading guru. Rolf, we haven't seen or heard from Rolf for a long time, but he's been a Danielcode member for many, many years. Scott, great having you with us. And the other Scott who's doing a tutorial, I thought you were on your way to Boston. Maybe you are. Terry's with us. Tom, the wealth manager from Florida. Great to have you with us, Tom. I hope your partner's recovered, doing well. He was pretty sick last time. And of course, Trevor. So what have we got here? What does Elon say? Who needs SpaceX and Tesla when I've got the Danielcode? Good on you, mate. Hi, John. Alan from Fort Lauderdale. Great to have you with us, Alan. And yeah, Scott's got to Boston, and he's in his hotel room. Well, that's dedication for you. Good on you. Lovely to have you all with us, folks, and just a whole lot to talk about today. So let's get ourselves moving. Boy, I mean, trading's been great, hasn't it? Markets, as you know, are rational, orderly, and sometimes predictable. As you know, we call the recent top to the day and pretty much the tick and the low as well. So now we're charging back up. So very, very interesting. So this time a fortnight ago, now fortnight's not an American word. My American friends often say, what's a fortnight? Well, a fortnight is 14 nights or 2 weeks. I guess it's a British expression, Australian expression. But this time a fortnight ago, the world was worried about COVID-19. That's all we were talking about. And it's been blasted off the front pages by the stories of riots and looting in America's major cities over the George Floyd death. Amazing stuff. New York features heavily, as it did with the COVID-19 pandemic. Seriously, it's a city that's had a bad time. Los Angeles, predictably, not far behind. Washington's been a flashpoint. Huge dramas there with the protesters focusing on the White House. And As you know, everyone knows, I guess, this started with the death of George Floyd during a forceful arrest in Minnesota. And what started as peaceful protests over his death then morphed into riots and looting. And they spread in a small way to UK and Europe. And there's even a suggestion that there could be a protest march in Sydney today, which I don't know whether they'll allow it. They're still supposed to, well, they're only a couple of weeks out of lockdown, so we'll see what happens. But it's an extraordinary thing, isn't it? And it's going to play out for a long time. And the death of George Floyd, really terribly regrettable, and we've seen far too much of it, that sort of thing already. But I do think the Attorney General's drawn a pretty long bow in charging the other 3 policemen who were on that same detail. And I think that's a bit of political pressure. Of course, attorneys in America are political appointees, and they're not immune to public pressure. Very, very sad, the whole thing, but the damage that's been done is just absolutely massive. So the cost of COVID-19 is ongoing. It's still being calculated. You think of the industries that have been affected by it, and the bailout cost, the support cost for citizens and corporations, great and small. It reeks of disaster, and markets at this stage are paying absolutely no regard to that cost. The Australian Federal Treasurer, Josh Frydenberg, came out this week and said the amount of money that's been put forward by governments, both state and federal, into supporting various structures, various groups, it's going to take, he says, it'll take 30 years for it to be paid off. Well, of course, for countries that have their own currencies, it's never going to be paid off. Normally you'd look at it and say, well, inflation will inflate it away, but inflation's so low, it's going to have very, very little effect. But there is a real and very, very substantial cost to what's happened with the COVID-19 pandemic. And markets, for one, are just not concerned about that at all. And we're certainly, that's going to be the theme of what we're going to be talking about today. So over the weekend, it came to me that we should be talking about how markets are reacting not only to the COVID-19 pandemic, but also to the rioting that's been going on in the States. And I put that together on Sunday night, that there's plenty of bad news around, but what the markets say, markets are cheering. They think it's got great news. So then a few days later, in fact today, Bloomberg seemed to pick up on that. I don't know if they're coming to the webinar today. They certainly picked up on that theme and came out with some terrific charts, which I'm going to show you, that really give you some insights into how the market's reacting, and really, more importantly, some insights, folks, into what the markets are doing, but why they're doing it, and how that's going to fit into the longer term picture. And we're going to go through all of that today. So this is the NASDAQ, which on the index, this is the futures contract, on the index, it's actually made an all-time high today. Extraordinary. But you can see the, believe it or not, this is a daily chart. That's the sort of a pullback you expect to see over a period of months. We got all that pullback virtually in 30 days. February 20 was the top, and March 21st was the big snapback low. So we had all of that disaster in a month. Then even more extraordinary, it's been recovered in beginning of June. Incredible, isn't it? And we're going to see more of that in detail as we move along. But there's the NASDAQ. It's the most bullish part of the various indices. But the others aren't far behind. Here's the Dow. This is Mr. Trump's favorite measure. of market performance. He likes to talk about the Dow, and you can see it's recovered already about 73% of the COVID-19 pullback, which, at the time looked like it was going to be something pretty serious. I'm glad I only ever called it a pullback, because that's all it is so far. And this recovery is quite extraordinary. Here's the Russell. This is the Russell 2000. This is the small caps index, folks. And this has been the weakest of the major indices. You look at the equity indices, Dow, Russell, S&P, NASDAQ, and Germany's DAX. They're all very, very highly correlated in direction, and also significantly correlated in price. But this has been the worst of them. This is the small caps index, and as you can see, it's on its way to the 74% retracement. So it's retraced better than 70%, and it's the weakest of the indices. Despite everything, this one, all of them, but this one's most noticeable because it is the weakest of the indices, is massively, massively higher than the start of the Trump presidency in February 2016. He really is one of the great salesmen and boosters of all time. He's certainly very good for the stock market, and he seems to have an iron grip on the key players. So here's the S&P, which is really our benchmark, and it's up past the red line. You can see it's a 74% retracement of the COVID pullback. It's recovered that, and it's roaring along. So this is where it starts to really get interesting. So most of these charts in the next 4 or 5 I'm going to show you come from Bloomberg. And it's reached the index. Well, the futures are close enough to a new high as well, very close. But the index has made a new high. But this is really interesting because it's Bloomberg has charted the NASDAQ 100 against the NASDAQ 100 consensus for 12-month forward earnings per share. And you can see that the consensus for forward earnings per share is languishing, bashing along the bottom of the chart with just a bit of a rally in May, but nothing significant in the scheme of this chart. But at the same time that it's been disastrous, the NASDAQ 100 has gone to new highs. And that's extraordinary, and we really should be asking why. Zero Hedge has a nice snarky comment on it, saying it's reached a new all-time high today because of the fundamentals. And Zero Hedge is, like me, fairly cynical about fundamentals, and economists who I have labelled as witch doctors, because they can always tell you reasons for everything, but they can never tell you the time. But for those of you who believe in fundamentals and are doing your investing in stocks and shares based on fundamentals, it's a pretty grim time at the moment, because they just ain't there. I use the pejorative quite willingly. So this is also a Bloomberg chart, and this is the Fed. This chart's showing you the size of the Fed balance sheet. In other words, it's measuring the massive, massive increase in the Fed balance sheet, which, well, it's been strong. It hasn't been increasing dramatically since September last year, but it's already taken off. It's gone on the space shot trajectory, hasn't it, since the beginning of March. And that's a crude measure of the funding that the Fed's putting in to liquidity, advanced liquidity, market support, buying of government instruments, and now buying of non-government instruments. So when Bloomberg say this is the Fed, you can see that it is. Now, they've matched the two charts on some ad hoc basis, but it certainly does show the point that it's the Fed spending largely that's been fueling all of this. They, in fact, put the Fed support as accounting for 73% of the rise in the S&P since the March lows. I'm not sure how they get that 73%, but it's certainly been very, very significant. And here's another chart also from Bloomberg. This is the greatest 51-day surge in stocks since June 1933. Think about that date, 1933. That's the end of the Great Depression, the 29 Depression. I mean, that is a significant item, and this is the greatest 51-day surge rate of change, in fact, since then. I mean, it's extraordinary. It really is. Interestingly, because there's another item that's fueling all of this, is that the money cost is still negligible. This is the 10-year yield. It's jumped a bit in the last few days, but it's still really it's negligible. That's the only word you can use. So what's different about this pullback is that it started, well, there's hardly even a pullback left to talk about, but when it happened, the Fed was at a position where they were already expanding their balance sheet, very strong monetizing QE light or QE silent, if you like, and interest rates at a level where they couldn't go much lower. But they're still flooding the markets with liquidity, and more than liquidity, they're actually actively supporting the important parts of the market. And that's important, as you're going to see when we talk about what's fueling this madcap rally. So the dollar was dumped again today. This is the Bloomberg Dollar Index, but the dollar's been down for a while. And against the euro, this is the biggest 14-day drop in the dollar since October 2011. Euro explodes higher. Longest streak of gains for euro since 2011, according to Bloomberg, but you'll see that other markets have been even stronger, particularly the energy-type markets. This is an extraordinary chart. This is the ratio of the NASDAQ to commodities. I mean, the statement from Bloomberg is tech stocks have never been this expensive compared with raw materials. But you can see there's a total divergence, total and utter divergence, I should say, between the NASDAQ and commodities, whereas normally they're not highly correlated, but there's always been a substantial degree of correlation, other than on this chart at least. You can see a bit of a blip in 99-2000, where commodities got the NASDAQ. Well, that's the height of the dot-com bubble, isn't it? So it was only there temporarily. But apart from that, you can see there has been a degree of correlation, which has totally disappeared now. So equities, very, very expensive. Commodities, pretty cheap. And this next chart, as you can see, is charting the small cap price earnings ratio. This is the Russell, is the small caps index. It's price earning ratio. It's forward price earning ratio. And look at it off the chart. We've never seen anything like it. So the Russell is the weakest of the major equity markets. Yet the value of the Russell, the forward price earnings ratio of the Russell, has never been higher. Certainly this chart starts in 1995, and apart from the little blip up, decent blip up I should say, 2009, 2010, where the 2007-2009 crash was over and markets were starting to recover. But you can see that this price earnings ratio is through the roof even compared to that. Buybacks, something not talked about very much, and they're the rocket fuel of these markets. So you're all aware what buybacks are. Stocks, corporations borrow money, and they use it to, instead of investing it, they use it to buy back their own stocks. And that has an immediate effect, of course, of increasing the stock price, as it's reducing the volume of shares that are still available in the market. So the reduction in shares or stocks, if you prefer, of necessity tends to increase the price. And if that's done on a sustained basis, it has a big effect on the price. Now, Goldman has estimated that better than 50% of the buy impulse in stocks is attributable to buybacks. Think of that. That's just a massive, massive number. And this is where corporations borrow money, use it to buy back their own stocks and shares. Back in the day when I was a practicing attorney, which is some years ago now, admittedly, there was a blanket prohibition against corporations buying their own shares. So dividends were the prime method of rewarding shareholders, and there are all sort of implications, tax implications, in particular, to differentiate between shares, between dividend on shares, which is income, and capital gains on stocks and shares, which may not be income. But there was an absolute blanket prohibition against it. But first of all, the American regulators loosened that, then let it go completely. And of course, the other Western countries around the world have followed that in allowing buybacks. And they're now an everyday occurrence. But they have a much larger effect on stock prices than you would think. When you see the announcements that XYZ Corporation is buying back X number of shares, it's usually pretty low key, but the effect on the market is dynamic, and it's there to push prices up, and it's designed to push prices up. And that's what it does. So if you link that to the fact that executive compensation these days is largely linked to the share price and the rise in the share price, it's what triggers these massive, massive executive compensation packages. So there's certainly an argument that, that's not a great thing, but that's a real old-fashioned argument. It's the norm now. But think, for example, of other methods of rewarding executives, particular KPIs, key performance indicators. Most executives will have that written into their employment package. In the case of the big corporations, all corporations pretty much, there's an incentive for a better share price if they're publicly traded companies. And look at the most common alternative, KPIs. We've had the extraordinary situation here that Rugby Australia, that's rugby union, the officers' game, which I'm a great enthusiast and played for too many years. I was still playing rugby when I was 33, which is why I've got so many arthritic spots from broken bones being dropped on your head too often. Anyway, great game. The Rugby Australia has been absolutely decimated in the last few years by poor performance, dreadful governance, totally incompetent executives, and they brought in this, I keep using the word extraordinary, woman, Raylene Castle. Those of you who follow rugby, and I guess there's very, very few of you, probably have not been able to avoid being aware of her. But she was brought into the game as chief executive of Australian rugby with a pretty shaky CV. She'd run Netball New Zealand, I think, or maybe it was Netball Australia, something that's not on my list of interests. But in the last 3 years, Australia, which used to be a world power in rugby, has gone from being rated number 2 in the world to number 7 I mean, it's disastrous. It's never been lower. It's never been worse. Now, that's a little bit deceptive because the British countries, Britain, Ireland, Wales, and Scotland, all compete in this particular measure as individual countries, whereas the national team, the British team that combines the British Isles, the British Union, it's a real power player, real power house of rugby. But so are their individual teams. But the fact is that she left. Australian rugby got the stage. It's broke, has no money. It's having to borrow money from the parent union in UK. Its ratings are dreadful, and it's with COVID-19, of course, they've shut it down. It can't be played at the moment, and there's no broadcasting deal in sight for if and when they ever get back to playing. But the key point is, talking about key points and key performance indicators, the auditors, Deloitte, I think it was, might have been ENS, I should say, very, very big firm, institutional firm, managed to agree with the compensation board of Rugby Australia that this woman had achieved 72% of the KPIs. But, I mean, the game's a disaster. Financially, they're broke. Performance-wise, it couldn't be worse. I mean, what were the 72% of KPIs that she achieved? I mean, was it making tea and toast in the morning? It certainly can't have had anything to do with the business because truly it's just been an absolute disaster. And who knows when we're going to see some good international rugby again. And unfortunately, the Australian teams are all so bad at the moment that watching a domestic competition doesn't have a lot of appeal. But watching the All Blacks, the New Zealand rugby team, and the South Africans, and the British, of course, and sometimes the French, even the Argentinians, is greatly entertaining. But we don't know if and when we're going to have any of it. So buybacks are the real rocket fuel. 50%, great, according to Goldman, more than 50% of that buying impulse comes from a buyback. So take the situation where we are now, unlimited liquidity supplied by the US Fed for its markets, and not only is it in the US, the same thing's happening in Europe, the same thing's happening around the world. Add to that negligible interest cost for major corporations, together with the motivation always from executives, increase the share price. The most effective way is through buybacks, because that's what's going to trigger your executive compensation package. And human nature being what it is we've got to see pretty well on a daily basis, or a nightly basis at least, in a lot of the bigger cities in the US. Human nature will always do its best to reward itself. Not that I'm comparing the markets to the rioters and looters, although there's certainly a percentage of those well hidden in the financial markets. But it's a perfect storm for positive momentum in US financial markets. Unlimited liquidity, plus buybacks, very, very negligible interest rates, equals launch, and there you have it, and that's the impulse. Okay, we move on. I'm just going to have a look at our fourth seal now, and I've called this in praise of Frank DB, who pretty much runs the fourth seal for us. And Frank, for those of you who didn't know or haven't been with us before, Frank's a young man, quite young. Well, at my age, most people are young, but Frank's certainly young. And he came to a tutorial in Taupo, New Zealand, back in 2010 or 2011. And he came to say hello to me before the tutorial. We usually have a meet and greet and a few drinks together, say hello before the tutorial gets started. And he came to introduce himself to me. Very good-looking young gentleman, quietly spoken, impeccable manners. And he's a Belgian lad. And he brought with him his fiancée, Anne. as she was then. They're now married. He has 2 lovely children. And he said, I've never seen a financial chart in my life, but I want you to teach me trading because I've read all of your articles and I love what you say and what you write. So from there, Frank went from being a person, as he said, never seen a financial chart in his life, to an absolute terrific analyst. And coincidentally, I should say, that was the first time that I'd ever taught the 4th seal at a tutorial. And Frank latched right onto it, did so much work, he made it his specialty, and he now helps me with creating the 4th seal charts and commentary every week. And this is what he's had to say about the S&P. The market keeps going higher. The 59 cycle comes from a low. Since the market goes higher last week, odds are that this 59 cycle will invert and give us a high. We're on alert for a formation of a swing high. DC sell signal will lead the way. Any sell-off is likely going to be a counter-trend affair long-term, as this market is set up for new highs in 2021. Now, in the next slide, I'm going to show you a link. It might be a couple of slides on, a link to Frank's article, which he wrote for us in Christmas last year. And he said that on his analysis of the Danielcode time cycles, the probability was, remember we always hedge these comments, predicting the future is perilous at the best of times. But he said in that article he was forecasting the market would make a high in late 2021 and gave his reasons. Then immediately after the COVID crash, while it still looked like it was going to be a serious thing, he came out and said, I know it's silly to say this, but I still believe the market's going to go higher in 2021. So for those of you who are regular supporters at our periodic webinars, you got that from Frank the week it came out. So his 4th seal commentary is available at the Danielcode website. It's $125 a month, the cost per market. We cover 3 markets, S&P, gold, and crude oil. And there's no link to subscribe on the website. You just need to write to Terry, support@thedanielcode.com, support@thedanielcode.com. His name is Terry Knight. He's our webmaster and IT guru and a lovely guy to boot. And he will tell him which markets you want and for how long, and he'll invoice you. And if you're subscribing for longer than a few months, he will offer you a discount as well. So let's go on. This is Frank's comments on gold here now from Monday of this week. The recent 44 cycle low still pushing gold higher. Odds are that gold goes higher at the next cycle top, which is a 59 cycle top coming up on June the 30th. This leaves gold with a lot of room to go higher, mainly looking for buy signals here. There are no immediate cycles ahead to stop gold's up move. The 6-day trend looks very good. Incidentally, we don't correct Frank's grammar occasionally. He actually speaks very, very good English, but it's his second language, and occasionally there's the odd word, but we don't correct that. It's part of his charm, and he's to be congratulated for how well he does speak English. So that's his take on gold. And of course, in talking about forecasting, there's a great risk in forecasting, and forecasting, the methods we use are Danielcode time cycles. And Sir Isaac Newton, the father of modern science, was also a great admirer of the book of Daniel. What's not well known is that Newton actually wrote more about his Christian beliefs than he did about his mathematics and physics insights. Of course, the man who defined gravity. So he had this statement when he wrote prophecies, observations upon the prophecies of Daniel. I've copied it. It says, the folly of interpreters has been to foretell times and things by this prophecy, as if God designed to make them prophets. By this rashness they have not only exposed themselves, but brought the prophecy also into contempt. The design of God was much otherwise. He gave this and the prophecies of the Old Testament not to gratify men's curiosities by enabling them to foreknow things, but that after they were fulfilled they might be interpreted by the event and his own providence. So that's the word in that expression, God's will, referred to as providence back in the day. His own providence, not the interpreters, be then manifested thereby to the world. For the event of things predicted many ages before will then be a convincing argument that the world is governed by providence. Excuse me. So that's a warning statement from Sir Isaac Newton that he wrote, and which we have adopted, and that appears on the Fourth Seal commentary every week. So here's the link to his article at the top here. I should have changed the color of it. I do apologize if it's a bit hard to see. It's a dark blue on a mid blue. It's not a great idea, but yeah, you'll be able to click on that link. It's active, and you'll be able to go to Frank's article. If you have any problems finding that, go to the Danielcode website, click on the articles tab, and it's in there. It's at the top of the list of articles. So you can read this yourselves. I've talked about it, and it's pretty much the definition of brave, isn't it? But if Frank's prediction is right, it's got some really interesting implications. Basically, the implications are that Trump wins re-election in November. The market goes higher. It keeps going higher. I mean, we are finding out that there are many things that Mr. Trump is not, but he certainly is a great market booster. He's clearly a great salesman, a great spruiker, and he's done a great job of talking up markets and ensuring that people who control some aspects of that market, namely the Fed, are doing their best to help it along. But if Frank's interpretation of the Danielcode cycles is correct, and this market does go higher into late 2021, that tells you, doesn't it, that Trump wins the election, and markets are happy and go on. He keeps rubbing their tummy, and they go on smiling for a while at least. Very interesting, isn't it? Lots to think about there. But if you want to keep up to date, you're most welcome to get a free trial of the Danielcode, where you can see Frank DB's comments every week on Monday, or you can subscribe to one of his services. So the only real notable effect that we're seeing, and it's not that dramatic either, of the COVID-19 damage, which is really what's all about, is the US dollar index. And this is a chart you've seen many times. This is the 24-day chart. Each bar on this chart is 24 days. I show this to you periodically. And you can see that it went up and double topped at the high, the 103.93 high, and it's on its way down. But it's nothing terribly dramatic there. It's still above, way above major support. But it's been significant enough to have a dramatic effect on other markets. This is the one of the what I call the energy markets, Australia and Canada. This is the AUD-USD pair in Forex, which was our favourite short for the last few years, including this year. And we certainly have had a massive rundown. It's got down to 55 cents, was pretty sensational. But this is a 6-day chart. But look what's happened since that low. Or I should say, look what's happened since the high in the US dollar. This thing has roared. This has rallied. It's up pretty close to 70 cents from 55 cents. That's a massive, massive move. 15 cents in the dollar. Boy, that's a biggie. And same things happen to the New Zealand dollar, which is not really an energy currency, but it's it's very highly correlated with the Australian dollar. And in fact, Australia is by far New Zealand's biggest trading partner. Excuse me. So the same things happen there with that currency roaring up. So think a bit about tempering your enthusiasm on the markets by realizing that on a global basis, you are losing a substantial percentage by the weakness of the US dollar. Trump wants to have a weaker US dollar, and he's getting his wish. Most businessmen, those on the export side at least, love the weak dollar because it makes their product weaker relative to international currencies. So Trump, being a hotelier basically and a purveyor of golf courses, other items of leisure and grandeur, he was always in favour of a weaker dollar, and he's getting it now. But if you're holding currency, US currencies, excuse me a moment, please. Thank you. Someone's answered that, thankfully. You are getting a bit of a loss on your US currency. But if you're not planning on traveling anywhere at the moment, then there's no problem. It's just onwards and upwards. This is a picture of a chart, I should say, of our Success program on crude oil. We've just made an absolute fortune on crude oil. We had the big pull down, the big collapse in about 3 different trades, and it was just massive. And this is the recovery, and you can see here the bars that don't have a blue line of dollar value on them is where we've probably been long and short. Now, it doesn't mean we didn't make money, but it means we could even have lost money. But our biggest loss we ever have on crude oils, $834 at the moment. That varies. That's a percentage of an average daily range, which is gets updated not too often. We use a very slow 255-day moving average for that. But you can see on crude oil, just this recent rally, there's some part of $18,000 profit in those success trades. So do have a look at them if you're interested in trading. You're most welcome to have a free trial of the Danielcode, and you can 14-day free trial. You can see these success signals every day, and there's some great value on them. This is the US dollar index. We had a little 550 down trade a couple of weeks ago. At the moment, we're in a trade that so far returned $2,900 odd dollars on the short side per one contract. Every time I tell you any of these figures, it's always excuse me, for one contract. Sugar, I'm showing you this because it's got a very small margin. Some of our clients are struggling with margins as the CME keep whacking up the margins. Sugar, when I started recommending it to clients and covering it, it had a margin of $500. And they've doubled that now to $1,000. But as you can see, just in 2 trades here, on the success, there's $1,000. That's 100% of margin just in those 2 trades. So for those of you who are looking for a market with a smaller margin, have a look at grains and also have a look at sugar. This is T-bonds. This is our 6 seal on US T-bonds. You can see there's we're in a $3,000+ trade at the moment. There's been a 1,500, another 1,500. Call that 2,000. That's close enough to some part of $5,000 in there, and the biggest loss you incur in T-bonds on a counter trend trade is $495 at the moment. That's our counter trend value for T-bonds. So do have a look at the success, please, for your own benefit. It's making a lot of money, and it's really easy for you to follow. Suhasini has joined us. Welcome, Suhasini. Nice to have you with us. I got your email. I haven't replied yet. I'm a couple of days behind on my emails. You must forgive me. But I'm glad you're back into the trading and going well. and of course Sue L up in Cairns. Great to have you with us, Sue. And let's forgive me for being across the bit off target there, a bit off subject, but let's move on. I wanted to show you just briefly, we only have a few minutes left. In fact, we still have about 15 minutes left, but I wanted to show you the Danielcode Targets. The biggest difference in the Danielcode to any other trading program that you have then or will in the future see is that we create on the charts for the futures and Forex these targets, which are Danielcode ratios. They're not Fibonacci numbers, they're not old highs or old lows, they're nothing you've ever seen before, but I wanted to just draw your attention to the fact of how incredibly accurate they are. So it's fair to say with some of these markets, you finish up getting a whole lot of numbers on them. And that's because each swing in a chart the matrix of the swing will create a new sequence of numbers. The market's creating its own numbers by its own price movements, but every time there's a noticeable swing, it creates another ratio. And if there's a criticism, you could say, well, there's so many numbers, which one's it going to stop at? We don't know that because we don't have foreknowledge. We don't know what's going to happen tomorrow, nor does nobody knows. Anybody ever tells you they know what's going to happen tomorrow, run for your life. But the difference is that markets know and understand these Danielcode levels because they're created from the price level of the markets themselves. So that's not surprising. But what I think you may not be aware of is how incredibly accurate this target recognition is. It doesn't matter if there are a lot of targets, because when the market is giving target recognition, and I'm going to show you some of them now, the accuracy is absolutely absolutely extraordinary. The high into the blue line that you're looking at on the Aussie US dollar chart was 69.84. There's the blue line, 69.87, 3 ticks variance. I mean, it's nothing. It's not even the width of a hair. 3 ticks. This is the Canadian chief Canadian Swiss franc pair. Have a look at this. The sell signal, the TO3 sell signal, came from the bar that set up 2 days ago on Tuesday, June the 2nd. And the high of that bar is 71.29. The Danielcode blue line is at 71.30. That's the sort of price behavior that you get when the market is finding a target. So the markets know and understand these numbers, and it's actually saying to you, I'm tracking these numbers. And when they are tracking a number, they hit it with such clarity that it is almost always very, very noticeable that is target recognition. So that was the bar that gave you target recognition and set up the sell signal. 2 days later, today, a nice sell from the TO3 sell signal. Let's move on. This next one, this is the euro, which Bloomberg was commenting on, that it's been racing against the US dollar, and so it has. And you can see here, this is the chart. These were updated on Wednesday night. So those were the levels that hadn't been reached on Wednesday night. Excuse me. And now it's roared up through those. This is a very, very high impulse move. This is a huge bar running up today. And target recognition in Danielcode Lexion is valid at a bar high low or on the close. And in this case, target recognition is on the close. Today's bar closed in EUR-USD at 113368. There's the number 113377. 9 ticks difference. Nothing. It's not even the width of the blue line. That's how accurate this stuff is, and it proves it to you day after day by doing the same thing. Here's the New Zealand dollar. Have a look. We get a 2-day look at this. Go back to Wednesday's bar. and you can see it closed. The close, again, we're looking at the high and or the close. Wednesday's bar closed at 64.22. There's the blue line it closed on, just below 64.25 and just above the red line, which was also support and resistance at 64.20. Then today, up it goes. Where does it go to? Today's high, 64.78 against the DC blue line, 64.75. 2 ticks variance, effectively nothing. And that's the market behavior that you get when these markets are finding these Danielcode numbers. This is a dollar-CAD, USD, Canadian dollar, the loonie as they call it. Have a look at this. Yesterday, you had the market on Wednesday, you had the market closing at 134.96 against the blue line, 134.95. Look at that. 1 tick variance. Today, you had the market punch through that support, turn around, almost hit the black line. The black lines are the last level of support or resistance for any operative swing. The low, it went down to 134.68 with the black line at 134.64. Got within 4 ticks of that, said, oops, sorry, turned around and reversed and closed at 135.00 against the black line there of the blue line, I should say, 134.95. 5 ticks variance there, 4 ticks from the black line. That's what makes the Danielcode unique, and I suspect that a lot of you are not getting the full value out of that. But the member charts are there; they're posted twice a week, and they're updated on Sundays and on Wednesday night. As well as that, if you look in the I should say the Danielcode website, you'll see a link saying Chart Archives. In there, there's over 30,000 charts that I've created over the years since we started in 2008, since we went public in December 2008. There are over 30,000 charts in there. Look at them, because you'll be hard-pressed to find a market that's ever turned anywhere except at a Danielcode number. And this is the same for equities, commodities, softs, grains, energies, forex, equity futures, bonds, all of them. All markets are ruled by the Danielcode, and they do this with a high level of specificity. Am I saying the word right? Specificity. You know the one I'm meaning. Be specific. I'm getting as bad as Joe Biden. Excuse me. This is T-Buyer. This is gold, folks, rather. This is your favourite for our friend up in Reading, who's a real gold man. What caused the big rally back in gold today? Big bar down, looked like it was going to keep going, didn't it? You can see here pretty clearly when you look at the members chart, the Wednesday's low was 1690.3. The Danielcode red line of support, 1689.7. That's 6 ticks variance. Now, in a number like that, there's 10 in gold. There's 10 ticks to the point. So there's 16,000 points in that number, and you had 6 points variance. I mean, it's extraordinary, isn't it? Even the rally back today, where did it close? 1724.4. Where's the Danielcode number? 1725.7. 7 ticks variance. Again, same thing. It's absolutely extraordinary. So if you're not using the Danielcode numbers, you're losing a big part of the plot. You're giving away the massive advantage that you have in following the Danielcode, because all markets turn at and only at these Danielcode numbers. And it should be your first mission every day to go to the Danielcode website, get those numbers, put them on your chart. Here's another example. This is Germany's DAX, which we have a number of European traders following. have a look at this. The high on Wednesday was 12,563. Danielcode blue line there, 12,557. 6 difference, and also 12,568. 5 points different. What was today's high? And that incidentally triggered a TO3 sell signal. And what was today's high? 12,564.5. 12,564.5. 3.5 points difference. Okay, I mean, it's extraordinary in the size of that. This is a market that moves in half ticks. So there's 25 odd thousand ticks in that number, and it's got a variance of 5. It's we say these things are accurate to 0.1%, but in fact they tend to be much more accurate. And the behavior of markets at these numbers, it's impossible to miss the fact that they're saying, I know and I recognize this number. Now, that doesn't mean a turn is going to happen. These numbers are support and resistance, but they are support and resistance of a type that no one's ever seen before. They are so incredibly accurate. If you're not getting the numbers from the Danielcode members charts every day, putting them on your chart, seeing what markets have done, you are losing a huge opportunity, because once you accept that markets will turn at and only at these numbers, it's the first thing you want to know. Is a turn possible? The first possibility is, do we have target recognition? That's the very first question you have to ask yourself every day. This is the Russell 2000. This is the small caps index. Same thing. Here's have a look at its price on Wednesday. There's the high, 1465.2. There's the Danielcode black line, 1466.5. 7 ticks variance. That same 7 ticks keeps coming up in equities. And this is a market. There's 10 ticks to point, so there's 14,000 potential ticks in that number. And you've got a variance here of 7 ticks. It's unmistakable to the human eye that what stopped that market on Wednesday was the Danielcode black line, the last level of support and resistance in any swing. Again, that doesn't mean of itself a turn is inevitable, but it does mean that it is a possibility of a turn, because markets will not turn anywhere unless they have target recognition at a Danielcode price number, either at the bar high low or on the close. That's the amazing thing, the extraordinary thing about the Danielcode. Here's soybeans, and this was a highly dramatic move today. Big roar up, and you can see there was tons of resistance there. Shot all the way through it, and finished up making its high today at 873 carat 2. There's the Danielcode blue line, 873.0, 1 tick variance. As I say, it's unmistakable when these markets are tracking the Danielcode numbers, and they will not turn unless they have target recognition. Just look at the previous day while we're on this chart. Have a look at Wednesday's bar, and the high of Wednesday was 858.0 against the Danielcode black line, 857 carat 6, 1 tick variance at the high, and the close was 857 carat 4 against 857 carat 6, 1 tick variance again. Extraordinary, isn't it? You can tell markets are trying to talk to you. They're actually saying, I know and I understand these numbers and I'm tracking them. Now they will break off that tracking and then they'll regain it. They don't have to do it every single day. You'll have periods where it does it every day, and you'll have periods where it will find numbers, then it will back off them a bit, be in no man's land, and then onto them again. And even though there are a lot of these numbers where the markets have a lot of swings, each of those swings is creating a new range of markets. The theoretically, the number, it goes from 0 to infinity. Thankfully, markets use the same 5 groups patterns all the time. So once we found the numbers, we can start using some statistical techniques to find out what's going to be the highest probability for us, and that's the great gift of the Daniel Code. And if you're not using it, friends, you're missing out, and that's sad. It's a huge advantage that nobody else has. You should be making the most of it. Okay, it only takes a minute. Train yourself to look at that. Here's what we should be doing while you're on sabbatical from your work or your place of fun with the lockdowns. Take this opportunity to learn to trade, I beg of you. Secure your financial future. Never have to worry about having a job, because you'll have a job always. Markets are never going to stop. They'll always be there for you. And if you want to be a super trader and join the elite, and we have plenty of them, email me, jneedham@thedanielcode.com. With your phone number and country and location. I'll be happy to call you, discuss your trading, and how I can take you from whatever level you're at now to becoming a elite trader and learning to trade well, profitably, and safely. And remember that I've had a number of people who've come to me saying, I've never seen a chart. I've never seen a financial chart. I have no idea what it is. And interestingly enough, they have gone on, most of them have gone on to make very good traders. 2 of them, in fact, have become the best traders that I've ever seen. Sage, of course, she's no longer with us. She was a gem and a super trader and a wonderful person. We lost her young and unexpectedly. And, of course, Frank DB, who I've told you about, the guru of the 4th seal. Also, never seen a financial chart when he came to me. Remember this, please, folks. The business of trading futures and Forex is not about being right, as you may expect. It is not to be right. The business of trading is to make money. That's the sole purpose of what we do, and we measure our success by the amount of money we make. I do assure you, it's a wonderful business to be in. You will always have the security of being your own master, and I can teach you everything there is to know about trading futures and Forex. If you haven't already, you're welcome to have a free trial, folks. Go to the Daniel Code website. Just click on the link, start your free trial. Any issues that you may have, contact Terry at support@thedanielcode.com, and he will get you sorted out. And this is our disclaimer, warning disclosure. Please, I beg of you, do not use real money trading until you are confident that you are a good trader. People lose money. Everyone loses money trading, and they lose it quickly. Don't believe that you can learn trading from the website. You can't. But I can teach you, and I would look forward to it. Let me know if you would like to learn trading. I'll be happy to have a conversation with you about what we can do and what we can offer you. So that's us for today, folks, and I trust you've had a good day, and I trust you've enjoyed the webinar today. Murph, glad you enjoyed it. Hank, didn't know you were with us. Glad you made it. And Janet, of course, lovely to have you with us, sweetie. I hope you're very well. Jeff, thank you. Glad to have had you with us. Look forward, folks. I'm thinking of doing another tutorial on Thursday of next week. It's out of sequence. It's going to be an extra one, but I want to show you a slightly more relaxed method of trading. This one-way traffic in markets is not going to go on forever. And I want to show you a new method of trading that's a little bit more relaxed, that's going to hold you in good stead when markets get out of the one-way traffic lane. So there we are. Thank you, Gig. I hope you're well over there. Hey, Gig, I heard that they were rioting at Myrtle Beach. We were talking about it the other day, weren't we? And I hope you're not affected, mate. Can you believe that, Myrtle Beach? Extraordinary. Gig's version is take away their cell phones and all the rioting will stop. Probably right. Janet, yes, always use more knowledge. Look forward to talking to you then. Gig says, no problem at Myrtle Beach, lots of bluster. Good on you, mate. Stay safe, everyone, and enjoy the weekend, and look forward. I'm here for you anytime. Any questions, shoot me an email, jneedham@thedanielcode.com, and I'll look forward to seeing you at our next webinar. All the best for now. Bye-bye.